Welcome to the world of Bitcoin ETFs. Before we dive into spot and futures Bitcoin ETFs, let's set the stage by understanding what ETFs are. Exchange-traded funds, ETFs, are investment funds traded on stock exchanges, designed to replicate the performance of specific indexes or assets. Imagine them as baskets holding various assets like stocks or bonds. ETFs are traded on the stock market, providing an easy way to buy or sell, diversify your portfolio, and manage risk, much like common stocks. Now let's explore Bitcoin ETFs. A Bitcoin exchange-traded fund, ETF, is a financial instrument enabling investors to track Bitcoin's price movements without directly owning the cryptocurrency. Traded on standard stock exchanges, these ETFs offer a simplified gateway for investors into the cryptocurrency market. Think of them as spot gold ETFs, holding physical gold on behalf of shareholders. Spot Bitcoin ETFs typically use third-party custodians to secure stored Bitcoin, ensuring a secure and regulated environment. The popularity of ETFs for both Bitcoin and traditional assets is soaring among retail and institutional investors. This is attributed to their regulated nature and convenient investment alternatives, especially for those cautious about directly dealing with cryptocurrencies due to security and other concerns. Now, let's distinguish between two primary types of Bitcoin ETFs, spot and futures. Spot Bitcoin ETF advantages. Gain direct exposure to Bitcoin without registering on a cryptocurrency exchange or setting up a wallet. Enhance portfolio diversification. Enjoy investor protection through regulations, offering a secure investment in a regulated product. Spot Bitcoin ETF disadvantages. Limited trading hours compared to crypto exchanges that operate 24/7. Incurs management fees for ETF management. While aiming to mirror the price of Bitcoin directly, there is no guarantee they will replicate exact returns. Moving on to futures ETFs. Futures ETFs use futures contracts to speculate on Bitcoin's future price movements. A futures contract is a financial agreement between two parties to buy or sell an asset at a predetermined price on a specified future date. In the context of Bitcoin, futures contracts enable investors to speculate on future price movements without owning Bitcoin. Which type of BTC ETFs are approved in the USA? In the United States, approval has been granted for both spot and futures Bitcoin ETFs by the SEC. Spot Bitcoin ETFs from multiple providers secured approval in January 2024, while futures Bitcoin ETFs, exemplified by ProShares Bitcoin Strategy ETF, received the green light earlier in October 2021. It's worth noting that when investors refer to a Bitcoin ETF, they are usually referring to a spot Bitcoin ETF. What is the scope of BTC ETFs outside the USA market? The United States dominates the Bitcoin ETF market, capturing 83% of ETFs, followed by Europe and Canada. However, smaller markets for spot Bitcoin ETFs are emerging in countries like Brazil, Australia, and Malaysia. As we wrap this video, it's crucial to reflect on the core philosophy of Bitcoin itself. Bitcoin was conceived as a means for individuals to truly own their wealth, free from the constraints of traditional banking systems. It's true, Bitcoin ETFs introduce a layer of abstraction. They represent a way for more traditional investors to gain exposure to Bitcoin's potential without directly holding the cryptocurrency. However, it's essential to acknowledge that by doing so, you're moving away from the original spirit of complete ownership and self-custody that Bitcoin championed. And may your crypto journey be as boundless as the possibilities it holds. Until next time, stay empowered, stay curious.